These are the precious metals that lost $6 trillion in a single day after the Federal Reserve's most dramatic policy reversal in decades. On January 30th, 2026, gold and silver experienced their most violent precious metals crash since 1980, erasing months of historic gains in mere hours, and leaving investors stunned as fortunes evaporated before their eyes. The catalyst came at 8:47 a.m. Eastern Time with a single announcement from Washington. President Donald Trump officially nominated Kevin Warsh to succeed Jerome Powell as chairman of the Federal Reserve. Unlike Powell, who had guided the Fed through years of unprecedented money printing, Warsh represented a fundamental shift toward monetary restraint, and the precious metals markets knew it. Within minutes of the announcement, the gold crash began. The gold futures dropped 8.7% to $51.14 per ounce. Silver crashed 16% to the psychological $100 threshold. But these headline numbers only told part of the story. The seeds of this crash were planted during the most extraordinary precious metals rally in modern history. Throughout 2025, gold surged an unprecedented 66%, while silver exploded by a staggering 135%. These weren't just numbers on a screen. They represented the largest wealth transfer into hard assets since the Hunt brothers' silver squeeze of 1980. By late January 2026, gold had climbed to within $5 of hitting $5,600 per ounce, a price level that would have seemed impossible just years earlier. Silver had reached $121 per troy ounce, more than 68% higher in January alone, marking silver's strongest monthly gain outside of December 1979. The precious metals market had entered what analysts called a parabolic phase, that dangerous territory where prices move so fast that gravity seems suspended. But gravity, as we learned on January 30th, is always waiting. The true devastation was measured in market capitalization. With gold peaking just $5 beneath $5,600 per ounce, the metal's 8.7% plunge knocked $3.4 trillion off the value of all above-ground gold worldwide. When you factor in silver's 30% crash from its peaks, plus the carnage across platinum, palladium, and mining equities, the total destruction approached $6 trillion in a single session. To put that number in perspective, $6 trillion is larger than the entire GDP of Japan. It's more than the combined market capitalization of Apple and Microsoft. In one day, the precious metals complex lost more wealth than most countries produce in an entire year. But who is Kevin Warsh, and why did his nomination trigger such a violent reaction? Warsh isn't just any Fed nominee. He's a central bank veteran who served during the critical period from 2006 to 2011, spanning the global financial crisis. At age 35, he became the youngest Federal Reserve governor in history. But it's his reputation as a monetary hawk that sent shockwaves through the gold and silver markets. In a CNBC interview last summer, Warsh called for regime change at the Fed, stating, "The credibility deficit lies with the incumbents that are at the Fed, in my view." Those words now carried the weight of policy. The market's reaction was swift and merciless. As Evercore YSY's Krishna Guha noted on Friday morning, the market was trading Warsh hawkish. The firm's vice chairman explained, "The Warsh pick should help stabilize the dollar and reduce the asymmetric risk of deep, extended dollar weakness by challenging debasement trades," which is also why gold and silver are sharply lower. This wasn't just about one man's nomination. It represented a complete reversal of the monetary conditions that had fueled the precious metals supercycle. For months, investors had been betting on continued dollar weakness, sustained inflation, and dovish Fed policy. Warsh's nomination shattered all three assumptions simultaneously. The technical destruction that followed was unprecedented. CME Group's COMEX, February gold futures suffered their largest single-day decline since January 22, 1980, settling down 11.37% at $47.1390 per ounce. Silver was even worse. COMEX February. Silver futures closed down 31.35% at $78.29 per ounce, marking the largest closing decline since March 27, 1980. But the real carnage was in the derivative markets. ProShares Ultra Silver, a leveraged silver ETF, plunged over 60% in a single session. The iShares Silver Trust ETF fell more than 30%, both marking their worst single-day performances on record. These weren't just numbers. They represented life-changing losses for thousands of retail investors who had piled into precious metals during the euphoric rally. The mining sector was decimated. Newmont Corporation, the world's largest gold miner, saw its shares tumble 7.6%. During Friday's session, U.S.-listed gold mining giants Barrick Gold and Agnico Eagle mines each fell over 10%, while Coeur Mining briefly dropped nearly 19%. Freeport-McMoRan, a major copper and gold producer, retreated 6.2% to close near $61. Matt Maley, equity strategist at Miller Tabak, captured the chaos perfectly. This is getting crazy. Most of this is probably forced selling. This has been the hottest asset for day traders and other short-term traders recently. So there's been some leverage built up in silver. With the huge decline today, the margin calls went out. The forced selling Maley referenced reveals a critical aspect of what happened. The precious metals rally hadn't just attracted long-term investors. It had drawn in massive amounts of speculative money, and much of it leveraged. A record wave of call option purchases had created what Goldman Sachs called mechanically reinforcing upward price momentum. But leverage works both ways. When prices move against you, the losses are amplified, and margin calls force additional selling, creating a vicious downward spiral. Technical analysts had been warning about this scenario for weeks. Multiple indicators had flashed warning signals before the crash. Gold's relative strength index had reached 90, the highest level for the metal in decades, indicating severe overbought conditions. Silver's technical picture was even more precarious, with some momentum indicators suggesting the metal was due for a significant correction. But technical analysis only explained the mechanics of the crash, not its fundamental drivers. The rally began in earnest in April 2025, following the implementation of the Liberation Day tariffs, which saw the U.S. impose sweeping 100% duties on major trading partners, including Canada. These protectionist policies sparked fears of global trade wars and currency debasement, traditional catalysts for precious metals demand. The Federal Reserve's policy pivot in September 2025 added fuel to the fire. After raising rates from 0 to 5.5% in the fastest hiking cycle since the 1980s, the Fed cut rates by 25 basis points on September 17th, followed by another 25 basis point cut on October 29th. For precious metals investors, this represented the beginning of a new era of easy money and dollar weakness. But it was the 43-day government shutdown from October 1st through November 13th, 2025 that truly sent precious metals into orbit. During this data blackout, normal economic reporting ceased, creating an information vacuum that precious metals bulls filled with increasingly aggressive speculation. Gold volatility spiked, hitting a nominal all-time high of approximately $43.79 in mid-October. China's role in the silver rally cannot be understated. In early November 2025, Beijing announced that starting January 1st, 2026, it would implement a special government license for silver exports, along with tungsten and antimony. This move effectively restricted 60 to 70% of global silver supply to domestic use, creating artificial scarcity that drove prices to unprecedented heights. The impact was immediate and dramatic. silver broke through $60 per ounce in December, reaching $64.20 before experiencing a brief correction. But the real fireworks came in January 2026, when Chinese social media exploded with silver speculation. Bloomberg described it as an eruption of interest fueled by social media that pushed silver to over $121 per troy ounce. The Chinese silver frenzy reached absurd levels. Trading in China's only pure-play silver ETF was suspended after promoters closed it amid huge volatility that took its stock market price more than 60% above the net asset value. Even after resuming, the premium to NAV remained at 34%, highlighting the disconnect between paper and physical markets. This disconnect between paper and physical silver became a central theme of the rally. London Bullion Market Association, LBMA, spot prices diverged significantly from CME Group's COMEX futures, reflecting global pricing mechanism strain. As precious metals consultant David Checkin noted, there is no doubt that the bifurcation between the paper silver market and the physical silver market will be expanded. Currently, the ratio of paper silver contracts to real, physical ounces of silver is 356 to 1. That's an inordinate amount of paper promises for every physical ounce of silver backing it. By late 2025, silver was no longer viewed as merely a precious metal. The U.S. Geological Survey's critical minerals list classification had elevated silver to strategic status, driven by what experts called the AI squeeze. The explosive growth of AI data centers, 5G infrastructure deployment, and photovoltaic manufacturing had created insatiable demand for high-conductivity silver wiring and connectors. Major tech companies like Samsung were reportedly bypassing global exchanges to negotiate direct supply agreements with mines in Mexico and Peru. The Silver Institute's forecasts painted a picture of structural shortage. They projected ongoing deficits through 2026, with 2025's shortfall alone estimated at approximately 117 million ounces, one of the largest in recent years. Metals Focus projected a 95 million ounce deficit, bringing the cumulative 5-year market deficit to 820 million ounces, equivalent to an entire year of average mine output. Central bank buying provided additional support for gold throughout the rally. According to World Gold Council data, the 1,100 tons of gold purchased by central banks in 2025 served as a floor for the market. The National Bank of Poland emerged as the largest buyer for the second consecutive year, adding 102 tons and lifting its reserves to 550 tons. Combined with sustained investment inflows, global gold demand surged past 5,000 tons for the first time on record, pushing the total value to a record $555 billion. But as Michael Brown, senior research strategist at Pepperstone, observed, the market had become highly bubbly. Only a small catalyst was needed to trigger such a move. The Warsh nomination provided exactly that catalyst. The speed and violence of the crash highlighted how fragile the precious metals rally had become. Despite the fundamental factors supporting higher prices, supply deficits, central bank buying, currency debasement fears, the market had become dominated by momentum players and leveraged speculators. When sentiment shifted, these weak hands were forced to liquidate, creating the cascading sell-off that erased $6 trillion in value. The US dollar index's surge from a 4-year low added insult to injury. Because gold and silver are non-yielding assets, the sudden rise in the opportunity cost of holding bullion triggered massive institutional fund exits. Treasury yields spiked as investors repositioned for a more hawkish Fed under Warsh's leadership. Akash Doshi, global head of gold and metal strategy at State Street Investment Management, captured the dynamic perfectly. Trump announcing Warsh as his pick for next Fed chair has been a US dollar positive and precious metals negative. Looking ahead, the precious metals market faces an uncertain future. Warsh still faces confirmation hearings in the Senate, where his nomination isn't guaranteed. North Carolina Senator Tom Tillis, a Republican, has reiterated his stance that he will not vote for the next Fed chair until the Justice Department resolves its investigation into current Fed Chair Powell. Some analysts remain optimistic despite the crash. J.P. Morgan's Natasha Kaneva maintains that the trends driving this rebasing higher in gold prices are not exhausted. The firm forecasts gold prices averaging $50.55 per ounce by the final quarter of 2026, rising toward $5,400 per ounce by the end of 2027. But others see the crash as a fundamental shift. Critics compare the current environment to the 1980 peak or the 2011 double top, suggesting that precious metals may have entered a multi-year cooling period. The debate between bulls and bears will likely define the market for months to come. What's certain is that January 30th, 2026, will be remembered as one of the most dramatic single-day moves in financial market history. In a matter of hours, $6 trillion vanished as the precious metals bubble burst with spectacular violence. For those who rode the rally to its peak, the crash served as a painful reminder that, in financial markets, what goes up can come down with devastating speed. The lesson from this extraordinary episode isn't just about precious metals. It's about the fragility of momentum-driven markets and the power of policy expectations to reshape entire sectors overnight. As investors pick through the wreckage of the great precious metals crash of 2026, one thing is clear: the era of easy money that fueled this historic rally may finally be coming to an end.